Alright everybody, welcome back to my channel. Are you lost in your financial life? Do you have no idea what you're doing? Do you need an expert financial planner to show you the path to success and glory? Well, guess what? I'm your man. Today, we're going to talk about the financial order of operations. What does that mean? Well, if you have no financial plan, I want you to follow these steps that I'm about to teach you. And if you follow these steps, you will be rich like me. Are you ready? Are you ready? Let's go. Now, in this scenario, I'm going to assume that you haven't done jack for your financial plan. So you don't have insurance, you don't have any savings because it's too hard to save money. You don't have any investments because you can't defer gratification. You have nothing. We're going to start from scratch, and I'm going to build you a delicious, superstitious financial plan. Okay? Let's go. So, number one, if you have nothing, starting from scratch, you don't have any savings, nothing, I want you to buy a term life insurance policy if you have somebody dependent on your income. Does mommy live with you? Do you have a girlfriend that doesn't work that lives with you? Do you have children? Are you married perhaps? Do you have a mortgage? Does somebody depend on your income? If you were to die tomorrow, would somebody be screwed without your paycheck? If that's the case, you need to buy a term life insurance policy right frickin' now. Okay? Now, the rule of thumb, and some financial planners think this is wrong, but it's a good rule of thumb. You want to get at least 10 times your annual income in insurance protection, okay? Don't get anything else except term life insurance. You need it. It is the foundation of your financial plan. It is the first thing you should purchase when you correct your terrible financial habits. Buy a term life insurance policy. Step number 2. Now that you've bought your term life insurance policy, which you will buy because you care about your loved ones, right? Once you buy that policy, if you have a 401k at work, you need to get the match. For example, if your 401k match is dollar for dollar, up to 5% of your income, if you contribute your money to your 401k, you get an automatic 100% gain on any dollar invested in your 401k, no matter how crappy it is, okay? So step number 1, get a term life insurance policy, 10 times your income. Step number 2, if you have a 401k and it gives you a match, if and only if it gives you a match, then contribute up to the match immediately. I know, you may have to stop eating out 5 times a week, okay? Get the match, get the life insurance policy. Step number 3, you need to save 1 month of emergency savings in a high-yield savings account. What is 1 month of emergency savings? That is savings to cover your essential bills that you need to survive, to cover any unexpected emergencies, okay? 1 month. What is an essential bill? It's anything that keeps you alive. Your rent or your mortgage, your life insurance, your food, your utilities, those are all essential bills. And if you were to lose your job, you would need to cover those bills, okay? Going out to eat is not an essential bill, but there are a ton of essential bills that you need to track. So I want you to write down all your bills, and I want you to add up all your essential bills that'll keep you alive, and I want you to save 1 month of bills and put that money in a high yield savings account. Not the stock market, a high yield savings account. Once you have 1 month of emergency savings, you can then continue on to the next step. And I'll say this again, if you like my channel, hit the freaking like button on every video you watch. It helps promote my videos throughout the YouTube universe, okay? Hit that like button, subscribe to my channel, and then hit the bell button for notifications, okay? Let's go. Step number 4. you need to pay off any high interest unsecured debt. What is that? Is it your mortgage? No. Is it your car payment? Not necessarily. High interest debt is usually credit cards and personal loans, okay? If you're a child who's out of control and you can't stop your spending, you probably have a ton of credit card debt, okay? Now, I know there's some circumstances where you might have medical debt, but a lot of people are just irresponsible with their money. And if you've racked up a massive credit card balance, you need to start paying down your freaking high interest debt because it's killing you, okay? So, there's two ways you can do it. Let's say you have 3 different credit cards. You can either pay off the lowest balance credit card first and then roll that money into the next credit card, or you can pay off the highest interest debt first. Now, financially, paying off the highest interest debt first makes the most sense because the higher the interest, the more freaking money you're paying every month. But if you need small wins on your way to achieving financial freedom, if that keeps you motivated, that keeps you driven not to be a broke loser, then you want to pay off the lowest balance debt first. So if you have one credit card that's 10% and you have another one that's 15 and another that's 20, if you want one victory at a time, you pay off the lowest balance regardless of the interest rate. And then you would take that money and you would apply it to the next credit card. Now, while you're paying off one credit card, you want to pay the minimums on the other two. So pay off one credit card at a time. Put as much money as you possibly can. Because the faster you pay off your credit card, the faster you get out of debt. Isn't that a crazy concept? Okay? Pay off your freaking credit cards. Do one at a time, pay the minimums on the other. Okay? Once you eliminate all credit card debt, any personal loan debt, any of that other crap, and maybe your car loan, depending on what interest rate you have, I would say if it's over 3 or 4%, then you want to pay off that too before you go on to the next step. Once you pay that off, then we're going to move on to the next step. So far, we've got a term life insurance policy that protects your family if you were to die, okay? Step number 2, you get your 401k match at work if you have one. Step number 3, you save 1 month of emergency savings. Step number 4, you pay off high interest credit card debt and personal loan debt, and maybe your car debt. Any high interest debt except your mortgage and potentially your car. Step number 5, now you want to build your savings in your high yield savings account even more. You want to save, in step number 5, between 3 to 6 months of emergency savings. Yes, everybody says 3 to 6 months. How do you choose? Number 1, it's based on your comfort level. If you are comfortable with having 6 months of emergency savings, then do 6 months. If you like that big old delicious number in your savings account, that's the number you go for. However, if you're single, you don't have anybody dependent on you, you have a very secure job, you can get away with 3 months. If you have a mortgage, a family with health insurance, you may want to consider 6 months or maybe even more if that's what makes you comfortable, okay? So you want to save between 3 to 6 months of your emergency expenses in your high yield savings account. That is a very important step. Now, why are you saving money and not investing it in stocks, bro? Well, you might have an emergency where you have to access very liquid assets. That high yield savings account with all those dollars in there is to protect you from unexpected emergencies. Maybe your stupid sports car breaks down. Maybe you lose your job. Maybe one of your kids has to go to the hospital. You need that money to pay those freaking bills, those unexpected bills. That's why that's there. That money is not to be invested. It is savings. Only savings. Okay? So step number 5, we're saving 3 to 6 months of emergency savings in a high yield savings account. Where do you find those? Google it. Step number 6, also known as 6 in English. You want to max out your Roth IRA for both you and your spouse if you have one. Okay? What is the Roth IRA? It is a tax-advantaged retirement account. the federal government allows you to contribute $6,000 a year into your Roth IRA, or $7,000 if you're an old person that's 50 or above. If you have a spouse, that spouse, whether they earn income or not, can also contribute $6,000, as long as you have earned income, enough earned income to cover both contributions. So if you make at least $12,000 of earned income, you can contribute to a Roth IRA and a spousal Roth IRA and max that crap out every single year, okay? Why do you want to max out the Roth IRA? Well, once you put the money in, you can buy whatever investments you want. Whatever you want. I prefer you buy index funds that are invested in US stock, but you can buy whatever you want. Once you invest that money, it's going to grow tax-free. And then when you hit 59 and a half, you can withdraw that money and you're not going to pay any taxes or penalties. Okay? Literally, the second you put money in that Roth IRA, it's going to grow tax-free and you're never going to pay taxes on it again. It is a delicious, amazing deal. So once you save your money, once you have that emergency savings account, you need to max out both your IRA and your spouse's IRA every year, okay? Whatever you gotta do, whatever you gotta cut out of your budget, going out to eat, your stupid subscriptions to your clothing store that you buy, spend $200 a month on, whatever you have to cut, that's non-essential, you need to cut to save money. Because if you don't, you're gonna be freaking broke and miserable and lonely in retirement. And nobody's gonna give a crap about you, okay? You need to take whatever money you can and invest it and max out your Roth IRA, okay? That's step number 6. Step number 7. You need to max out your 401k at work and your spouse's 401k at work. Now, as of 2020, you can invest up to $19,500 a year into your 401k. And that doesn't even include your employer match. So remember previously we got the employer match in step 2. That doesn't count towards that limit of $19,500 a year. So you want to go ahead and max out that 401k every freaking year after you've maxed out your Roth IRA. Now, why do I say that you want to get the match first, then do your Roth, and then go back to your 401k? It's pretty simple. With the Roth IRA, you can choose to invest through whatever brokerage you want. The whole world is open to you. You can open a Roth at Fidelity, you can open a Roth at Vanguard, T. Rowe Price, whoever offers freaking Roth IRAs, your bank. There's tons of flexibility. And that allows you to choose whatever investments you want. Low cost, low contribution limits, low fees, whatever. You get to choose whatever you want with your IRA. With your 401k, you don't have a freaking choice. Whatever your company offers you is what you're gonna get. So if your company has one crappy mutual fund with a 10% expense ratio every year, that's your only choice, okay? So that's why I say get the match so you get that free delicious money, 100% return, then you max out your Roth IRA, and if you have money left over, then you pitch in more to your company 401k. Now, the 401k is very similar to the IRA. It gives you tax advantages, but you're allowed to contribute more money, but you're limited on what you can buy based on what the plan offers. But dollar for dollar, the Roth IRA is superior, okay? And now we're gonna move on to the final step. Which is step A. You've purchased a life insurance policy, you've maxed out your savings account, you've maxed out your 401k or your TSP, you've maxed out your IRA. If you still have investable dollars left over, then you can invest in a normal taxable brokerage account. Now, when you invest in a Roth IRA or a traditional IRA or a 401k, you have tax advantages. If you sell stuff inside of it, you're not going to pay taxes. You can do whatever you want inside of it and not have to worry about tax liabilities until in the future. In a taxable brokerage account, it's a much less efficient and more expensive account, because every time you buy or sell something, every time you sell something at a gain, you're going to pay taxes. So that's why it's the last thing that you want to do. You want to max out your tax advantage accounts first, and then you want to max out or put as much money as you possibly can into taxable investment accounts. I personally recommend Fidelity or Vanguard. Fidelity is better. It's a great brokerage because they have zero minimums to invest and their expense ratios are extremely low. They even have mutual funds with zero, literally zero expense ratios, okay? So once you open all your other accounts, they're all fully maxed out, then you can start investing in a taxable brokerage account. How much should you invest? However much you want. If you want to retire by age 59 or 55 or whatever, put as much as you possibly can into these accounts. If you want to retire when you're 65, you can put a little bit less in there. But overall, the more money you save, the faster you're going to retire, okay? So the choice is up to you. Does that make sense? Well, hope you liked this video. Hope you had an amazing time with me. If you like my channel, like it, subscribe to it, and hit the bell button for notifications. Okay? You guys have a wonderful day. Tschüss.